Good morning, everyone, and thank you. My name is Kerry Good, and my capstone is titled Tokenizing Trust, a permission blockchain architecture for tokenizing real-world assets inside regulated consumer banking. The heart of the project is not a currency, a token, or a speculative instrument. It is an architecture, a three-tier policy control system that any credit union, neobank, or large financial institution can plug into a modernized deposits, credit, and fee prevention economics. Now let's start with how I'll walk you through this journey. Here's the path. 13 sections, each short, each building on the one before it. Sections 1 and 2 frame the problem and introduce the architecture. Section 3 is the walkthrough. This is where you'll see the whole system move as a single transaction flows through it. Sections 4 and 5 unpack the engineering, the tech stack, the API service, and the AI layer sitting on top. Section 6 is the KPI dashboard, what this looks like as a running product. Section 7 is the money question. Net present value, initial rate of return, weighted average cost of capital. Section 8 covers the security and regulatory guardrails that are baked into the system. And Section 9 is the part I want you to remember, how this actually gets implemented inside a credit union, a neobank, and a large financial institution, because this architecture is deliberately institution agnostic. The rest of this deck is intentionally visual. If a slide looks sparse, that is by design. The words live in what I'm saying and in the dashboards and diagrams, not in the slide. Three numbers frame the opportunity. Number one, 140 billion a year. That is the scale of avoidable U.S. consumer banking fees as reported by the CFPB and the Federal Reserve between 2023 and 2025. Overdraft, NSF, late fees, interchange leakage, foreign transaction fees. Most of this lands on low and moderate income households. Number two, 35 to $50 billion. That is the projected size of the real world asset tokenization market in 2025. It is still small relative to capital markets, but it is the fastest growing segment of on-chain finance. And it is the rail that makes the architecture you are about to see economically realistic. And number three, 9.5 million Chime customers. Chime is my illustrative case study because it combines a large to moderate income member base, a non-bank operating model, the highest J.D. Power customer satisfaction score in 2025, and 13% of new U.S. checking account openings. Anything that works for Chime has to work for credit unions and large banks too. I designed for that. The line across the bottom is the thesis. This is not crypto for crypto's sake. It is a regulated permission architecture aimed at the actual fee and credit gap in consumer banking. With the problem, size, let's look at the objectives that drove the design. Every architectural choice I made has to answer these four objectives. Objective number one, tokenize deposits safely, not synthetically, not offshore, not through a stablecoin wrapper. We are tokenizing the actual deposit receipt so that the yield becomes programmable while the underlying cash stays in the insured bank account. Objective number two, cut avoidable fees. This is where smart contracts earn their place. Overdraft, cascades, late fee compounding, failed transaction retries, those are largely deterministic and can be prevented at the ledger layer with a well-designed payoff routine. Objective number three, expand thin file credit. On-chain income and expense data plus XGBoost with SHAP explanation gives us a credit signal that is both more accurate and more audible than a FICO-only model, which matters enormously for Reg B. Objective number four is the one most people miss. I designed the architecture to be institution agnostic. The same three-tier stack has to work inside a credit union with 8 branches, inside a neobank with no branches, and inside a large financial institution with 2,000. If the design needs a rewrite every time the institution changes, it is not a framework, it is a one-off. So why Chime as a primary illustration? Let's look at that. I picked Chime as a stress test for 3 reasons. First, the member base. Chime members skew lower income, and that is precisely the population hit hardest by overdraft and late fees. If the architecture reduces fee leakage for this cohort, it creates direct measurable social value, which ties back to the ethical leadership. Second, the operating model. Chime is not a chartered bank. It partners with the Bancorp Bank and Stride Bank. That means every regulatory question, such as deposit insurance, BSA, AML, Reg E, Rule 1033, already flows through a partner bank architecture. If the tokenization architecture can live inside the partner bank envelope, it can also live inside any bank as a service stack. Third, the scale and trust. 13% of U.S. checking openings in 2025, 2.2 billion in revenue, and the number one JD Power score. That is the permission to build new consumer products. The key point I want you to hold this through the next slides is that designing for challenge constraints forces the architecture to be portable. It had to work inside a non-bank, which means it can also work inside a credit union and inside a large chartered bank. That portability is what Section 9 is about. Now let's discuss the methodology I used to build the framework. So I built an architecture and stress tested it. So in the discover phase, it's primary sources only, CFPB, FedG19, Chimes S-1, FinCEN, OCC, no third-party sources. The design, 3 tiers, clean API, AI, machine layer, cybersecurity envelope, every choice mapped to a regulatory or economic constraint. In the prototype, working Solidity contracts, a thin file credit model in XG Boost with SHAP, a KPI model feeding the dashboard, and validated through scenario analysis, WACC, and adoption sensitivities, and an ethics review. So now let's look at the architecture. Here's the architecture in one picture. 3 tiers bottom to top, security running down the right side. Tier 1 is money in. Real dollars entered through a partner bank. We use USDC, which is Circle's digital dollar, which is backed 1-to-1 by cash and US Treasuries, as the on-chain settlement rail. Outside data comes in through Chainlink, an Oracle network of independent providers that deliver tamper-resistant feeds, since smart contracts can't fetch data themselves. Signing keys live in AWS Cloud HSM, which is a tamper-resistant physical device where keys are used but never extracted. They're certified to FIPS 140-2 Level 3, the same federal standard used for classified material. Regulators recognize it instantly. Tier 2 is the logic. 3 smart contracts. Programs on a blockchain that run automatically when conditions are met, like a vending machine for financial logic. They're written in Solidity, running on Hyperledger Besu, a permissioned Ethereum blockchain where only approved institutions validate. DepositReceiptToken is ERC20, which is the universal token standard every wallet already understands, representing a claim on an insured deposit. RewardAssetAMM routes yield to the member. AMM means automated market maker, pricing trades by formula instead of an order book. RWACreditLine opens a credit envelope backed by the deposit token, RWA meaning real world asset. So the credit line is collateralized by an actual insured deposit, not a volatile crypto asset. And a fee prevention engine catches overdraft and late fee events before they hit the customer. Then tier 3, what the member sees. The Chime Credit Union, a large bank app, consent uses OAuth 2.0, which is the sign-in with protocol that modern internet runs on, layered with FDX 6.0, the U.S. banking standard for sharing consumer financial data. That combination makes it Rule 1033 ready on day 1. The CFPB rule giving customers the right to access and share their data. In the right column, there's the guardrails. AML screening, HMAC signatures on every message, reentry guard on every stake change, 2 or 3 multi-sig HSM back keys, and ECOA logging on every credit decision. No fast lane, every transaction goes through every guardrail. Now, let me trace a real transaction through the whole thing. This is the working prototype of the architecture, which is rendered as a sequence diagram so you can see every actor and every message. So it starts, a member deposits $200. The mobile app sends a signed OAuth 2.0 request through the API gateway. The gateway calls the mint deposit receipt on the smart contract. The contract escrows the real dollars to the FDIC insured partner bank account. The partner bank returns an HSM signed confirmation that the money has landed. At that point, the contract reaches out to the Oracle and machine learning layer. Chainlink returns a price and confirmation feed. An anomaly detection model returns a z-score and determines, is this transaction inside the historical distribution? If it is, the contract stamps a yield rate on the token and mints an ERC20 deposit receipt back to the member. If it is not, the transaction is paused and routed to a human for review. What the member sees. The member sees a push notification. Your $200 is earning a 4.3% APY, end to end. This takes roughly 6 seconds. Notice what did not happen. The custody of the real dollars never left the partner bank. The member's private keys were never exposed, no path around the guardrails, every state change was signed, logged, and replayable for an auditor. This is the happy path walkthrough. The next slide zooms into the single most consequential branch of this architecture, which is how exactly does it prevent overdraft and late fees from ever being charged? Let's see. This is the slide that answers the single most important question about the architecture. How concretely does it prevent overdraft and late fees? Not reduce, but prevent them. So step one, a payment event arrives. Card swipe, ACH debit, or it can be a scheduled bill pay or a loan payment coming due. In legacy systems, these events flow straight into the core, and if the balance is short, the core emits an overdraft or NSF fee. That is the failure mode we are designing out. So step two, the free prevention engine intercepts the event before the core can settle it. In a single call, it reads two things: the member's available deposit token balance and the member's undrawn headroom inside their RWA credit line envelope. Because the deposit token and the credit envelope are both on the same ledger, this read is atomic. No race condition, no latency gap where an overdraft could slip through. So step three, the decision. If the combined balance plus headroom covers the payment, we proceed. If it does not, the contract still does not throw a fee. It routes to compliance review, which is the one branch not shown in the slide because it falls outside the fee avoidance path. So step four is the top branch, the easy case. Sufficient balance, we debit, and we're done. Step 4B, the bottom branch, the interesting case. The balance is short, but the credit envelope has room. The contract auto draws from the RWACreditLine at a regulated policy set APR. The RewardAssetAMM rebalances yield, so the member's tokenization is preserved. The member never sees an overdraft. They see a single debit, and on their statement, a small interest charge that is always cheaper than a $35 overdraft fee replaced. Step 5, both branches merge at the outcome node. The payment settles, no fee is charged, and the entire event inputs decision, credit draw, if any, is hashed into the on-chain audit log, which a regulator can replay it end to end. The blue guardrail ribbon at the bottom is the part that makes this defensible. Every path through this flow is bounded by three hard-coded policy constraints. Credit limits are enforced on-chain per member, no runaway exposures. The APR fee schedule are hard-coded to be Reg Z compliant, and repeated auto draws inside a rolling window are throttled and flagged to compliance, so we don't turn fee prevention into a predatory credit product. The result, shown in the gold ribbon, is 187 in fees avoided per member per year on average, and more than 99% of would-be overdraft events are resolved inside the contract without a fee touching the customer. Now, with the flow established, let's look at the engineering service that makes all this actually buildable. Now let's discuss the tech stack, starting with the ledger. Hyperledger Besu, which is a private Ethereum permission, EVM compatible. Every developer and author already knows it. Then the contracts, which are on Solidity, on OpenZeppelin, Testing, and Foundry. These are battle-tested libraries, so we're not reinventing the wheel. And the APIs, which are Node.js, OpenAPI 3.0, OAuth 2.0, over FDX 6.0, which is the standard, the CFPB signal as acceptable under Rule 1033. So there are no regulatory surprises. Data and AI, we use Python, XGBoost, SHAP, Snowflake, Airflow as well. And for security, AWS Cloud HSM at FIPS level 3, AES 256 at rest, multi-sig for privileged ops, and then FedRAMP style controls. So interoperability, again, it's Chainlink, USDC, and chain analysis. So every piece has a vendor, a support contract, and a documented failure mode. That's what makes it implementable inside a regulated institution. Next, let's explore how the stack becomes a platform. The API strategy is what turns the architecture into a platform business. B2P is a direct path. The Chime app or neobank app consumes these APIs natively. This is the headline use case. B2B, which is business to business, is the white label path. Community banks and credit unions pay a software as a service subscription, roughly $5,000 to $12,000 a month, depending on tier, and they get the full architecture behind their own brand and their own charter. B2B to C is the fintech partner path. A banking as a service provider, a card program, or an embedded finance platform drops in a single module and compounds its own ARR. The gold ribbon is economics, 4 independent revenue streams. Software as a service fees, 3.6% IM on tokenized deposits, interchange uplift from retained transaction volume, and share a yield optimization. No single stream carries a module. This is what makes it a real platform economy, not a feature. Now let's explore the AI machine layer that sits on top of these APIs. AI machine learning layer has 4 models with 4 specific jobs. So first, the credit model, which uses XGBoost with Shape, which is basically it uses on-chain cash flow signals, which monitors deposit frequency, velocity, and stability to extend credit to members without a deep traditional file. SHAP gives us the adverse action reasoning the ECOA requires. Then we have the yield model, which is a reinforcement learning across yield curve variance. It optimizes a blend reward with member return, institution NIM, and regulatory capital costs. The AML model, which is unsupervised learning plus graph features. It produces a z-score that gates the smart contract yield event from the walkthrough. Then we have the consent NLP, which reads actual rule 1033 consent text, classifies scope and duration, and flags when a partner's disclosed scope drifts from what we've seen before. The column at the bottom is the point. Every model ships with a SHAP explainer, a drift monitor, and adverse action logging. That's not a nice to have, it's built into the product. That's how it delivers on ethical leadership. Now, let's look at what the platform looks like when it's running. Before I show you the dashboard, I want to explain how I built it because the structure is the point. In most fintech projects, KPIs get picked one at a time. Someone wants TVL, someone else wants uptime, marketing wants member count, and you end up with a wall of vanity numbers that no CFO regulator can actually act on. I built mine differently. Every KPI in this deck has to pass two tests. Test 1, does it move the P&L? Test 2, does it map to an architecture layer? The result is a unified scorecard. An engineer, a CFO, and a compliance officer all read the same 6 numbers, and each one sees their piece of the system in it. Then we walk you through it. TVL at 152.4 million, a revenue KPI on the settlement layer. It's the balance base that earns net interest margin. The threshold is 100 million by year 3. Active on-chain members at 1.84 million, a revenue KPI on the API layer. This is reached. The threshold is 1.5 million by year 3. Net interest margin at 3.62%, a revenue KPI on the smart contract layer. The reinforcement learning yield model produces 28 basis points of uplift above a 3% floor. AML precision at 94.1%, a joint risk and cost KPI owned by AI ML Plus compliance. The 92% threshold is the guardrail that lets the system auto-dismiss low-risk alerts. Uptime, 99.98%, a pure risk KPI on infrastructure in the Oracle path. SLA is 99.9%, and we run consistently above it. Fees avoided per customer at 187, a cost avoidance KPI on the fee engine. The threshold is $150. This is the member level proof that the architecture delivers what we promise. Now let's look at the dashboard itself. This is what the platform looks like once it's running. Picture the head of digital openness on a Monday morning. The top row is growth, tokenized deposits, 152 million TVL of 18% quarter over quarter. 1.8 million active on-chain members, up 12.6. NIM on that balance at 3.62%. Base case plus 20 basis points from the RL yield model. The bottom row is trust and safety. AML precision at 94.1%, up from 87 at launch. Smart contract uptime at 99.98%, above the 99.9 SLA we sell B2B. The one I care most about, $187 in fees avoided per member per year, 42 year over year, multiplied by 9.5 million child members as an example, and that's the 1.16 billion refund figure from the Capstone. This dashboard refreshes every 15 minutes. The board doesn't have to ask what's happening. Now let's explore the financial case. As you can see from the profit and loss simulation, revenue gradually increases from 0.4 million in year 1 to 23.9 million in year 5. Compound growth rate of roughly 180% as software as a service contracts, NIM, interchange, and yield share stack. The OPEX is the stack cost layer. It grows from 3.4 million to 6.8 million, which is as the cost of services scales with volume. EBITDA, the diamond makers, is negative 3 million in year 1, narrows to negative 1.2 million in year 2, crosses break even in year 3 at 0.9 million, it reaches 6.7 million in year 4 and hits 17.1 million in year 5. These numbers are what feed the net present value and initial rate of return calculation of the next slides, so the financial case is internally consistent. This is the 5-year project economics at 11% weighted average cost of capital. So year 0, the build, about 14.5 million of CapEx, ledger, contracts, APIs, AI stack, and first year audit and compliance. Year 1, the ramp up. Revenue is offset by go-to-market spend, still Net negative, about 2.8 million. Year 2, we cross break even on a run rate basis as tokenized deposits start generating NIM and the first B2B contracts go live. Year 3 is the base case, 5.4 million ARR on roughly 150 million in tokenized balances. Years 4 and 5, multi-sided revenue, software as a service, NIM, interchange, and yield share compounds to 27 million. Headline net present value is 19 million. Initial rate of return 34.5%. Payback in year 4. At 34% initial rate of return with a 4-year payback sits comfortably above any bank treasury hurdle rate I know. The fair pushback is, what if weighted average cost assumption is wrong? Let's discuss that in the next slide. There are 2 pieces on this slide. On the left, the weighted average cost of capital to build. Cost of equity contributes 9.24%. After tax cost of debt contributes 1.37 for a blended weighted average cost of capital of 10.61%. So the assumptions are 70% equity, 30% debt, cost of equity of 13.2% via CAPM at a beta of 1.25, cost of debt of 5.8%, 21% tax rate, which is conservative for a regulated bank, but realistic for a fintech platform, and the right to sensitivity. So I ran a net present value across an 8 to 16% weighted average cost of capital range. The curve stays positive across the entire range. At 16%, the extreme, but the net present value is still about 13 million. 8%, it runs to 23 million. The case doesn't depend on cheap capital. That matters here because the first question about fintech build is, what if capital gets expensive? The answer is, it still works. Good economics are necessary, but not sufficient. Now let's discuss cybersecurity and regulation. Security and regulation are one design in this architecture. On the security side, HMAC-SHA-256 puts a tempered evidence seal on every webhook, so both sides share a secret key. So even if one character of a message is altered in transit, it gets rejected before a contract ever sees it. Entry guard blocks the single most common smart check exploit, where a malicious contract calls back into yours mid-execution to drain funds. Cloud HSM and FIPS 140-2 Level 3 is the federal standard for key custody in regulated environments. 2 or 3 multi-sig means no single insider can move money. AES 256 encrypts everything at rest, and Z-score monitors on-chain link prevent Oracle price manipulation. On the regulatory side, Rule 1033 over FDX 6.0 for data portability. FinCEN BSA AML wired into the transaction path, OCC custody guidance, ECOA and Reg B adverse action logging on every credit decision, GDPR and CCPA consent, Genius and StableX alignment for the stablecoin bridge. So the point is every control maps to a specific threat or rule. There's no security theater. That traceability is what makes this architecture presentable to a regulator on visit 1, not visit 3. As you can see, we have 5 risks, ranked technical to operational, in every mitigation in the architecture. It starts with smart contracts, which is a high risk. This is basically the risk that a bug or attack in the on-chain code drains funds out of our RewardAssetAMM. As you can see, Oracle is also a high risk. This is the risk that the price or data feed coming from outside the blockchain gets manipulated or goes stale, causing the system to make a wrong decision, like paying out yield against a bad price. We also build in regulatory risk, which is a medium risk. This is a risk that the rules change underneath us. Rule 1033 evolves. The OCC issues new guidance. Genius or StableX pass with different terms than expected. And then we look at the partner bank risk, which is medium. This is the risk that the bank holding our actual deposit fails, loses its charter, or unilaterally changes the terms of the partnership. And then we look at also operational risk, which is also medium risk. This is the bucket for the everyday failure modes. Someone loses a key, the insider goes bad, the server room floods, and we have 4 controls that handle it. This business model is a multi-sided platform for different types of institutions. B2C. So members get 3 concrete product benefits, which are a yield on deposits, a programmable credit line that actually looks at their cash flows, and a fee prevention engine that stops the overdraft cascade before it starts. B2B, roughly 4,700 community banks and 4,900 credit unions in the US that cannot build this themselves. So we white label software as a service at $5,000 to $12,000 a month with a compliance by design packet and a named success engineer. The B2B to C, which are neobanks, banking-as-a-service platforms, and card programs, we embed the module, they pay by volume, and we share in the compliance flywheel. The gold ribbon is the revenue story, which are 4 streams. That diversification is the difference between a feature and a franchise. Now let's explore how this becomes a business across institutional types. So let's take the same architecture, but deploy it 3 different ways. So starting with the credit union. The credit union would consume it as a software as a service through a CUSO, partner bank custody. The win is they get fee relief and thin file credit. Neobank would embed it natively in the app with partner bank custody, no deposit liability, and the win is ARR diversification and NIM capture. A large financial institution would on premises have a Hyperledger in their data center, Cloud HSM in their VPC, custody on their own charter. The win is B2B and B2B2C API revenue. Smart contracts and AI are identical across all 3, only the deployment and custody change. That makes it an architecture, not a product. Now let's discuss ethics barriers in CSR. Now let's discuss ethics. Ethics is engineered in and not bolted on. We start with fairness. So every model has SHAP plus a drift dashboard, and adverse action logging carries the audit trail. We have consent, which addresses Rule 1033 events parsed by NLP scope and duration written to an immutable log. We also address inclusion, then file credit plus the fee avoidance engine, measurable. So we grow this in 3 phases. Year 1, we prove it works. With 25,000 members, a $5 million cap, 1 bank, the goal is hitting our KPIs, not making money. Year 2 to 3, we scale it, open it up to a few business customers, 1.84 million members, aiming for 152 million in deposits, 5.4 million revenue, and this is our base case. So, and then year 4 and 5, we expand it, big banks run it on their own servers, 5.1 members, 470 million in deposits, 23.9 million in revenue. Each phase only starts if the last one hits its KPI targets. Now this is how I built the research. The purpose was to get the full picture with tech and money together. Strands are 3 parallel tracks, engineering, financial, and regulatory. Implementation was sequential. Each milestone fed the next. Then regarding integration was partial. Qual and quant merged at the recommendations. Sampling was purposeful. I studied Chime, credit unions, neobank, large financial institutions were picked on purpose, not at random. And the data was both public reports plus strategic financials. And then analysis was both themes plus modeling. And an integration point was final recommendations. The honest gap would be the analytic adequacy. A future focus group will let me quantify themes and turn this from partial to full integration. In closing, there are 3 takeaways. 1, the architecture works. 3 permission tiers, every layer trades to a specific regulatory or technical requirement. And then number 2, the financials work. 19 million net present value, 34.5% initial rate of return, positive across the 42% weighted average cost of capital band. This is actually a bankable business case. And lastly, number 3, this is the one I want you to take with you. It's portable by design. Same tiers, same contracts, same AI layer, deployable inside a credit union, a neobank, or a large financial institution. That portability is what turns this architecture into a platform. Thank you.